Welcome to my channel. This week we are going to discuss about the broader market, the leading sectors, the lagging sectors, and why one should not stop their SIP during this phase. So coming to the broader market returns, this week we saw 4 days of trading, and over there we had one negative day and three positive days, out of which we have gained positive returns of 0.21, which is not too good, not too bad. The market is currently at the neutral phase. I believe we are waiting for the final agreement to come out of from US-Iran war, and all the stocks are taking a breather at this point. Now moving ahead to sector-based analysis, we are at Nifty 50. One thing what we can observe here is the market is at the neutral phase, and from past 2 weeks there has not been much movement, especially within the range, and we can expect the market to be moving on the either direction owing to the outcome of US-Iran war here. Moving ahead with the leading sectors, Nifty Bank has been leading especially the private bank sector, has been leading the entire market segment with returns of 1.02 results. And this has been holding Nifty 50 pretty much clearly in this current scenario. And coming to other sectors, Nifty Healthcare has made 1.88 returns. And in the past, we had given a point saying that yes, this is the sector which has broken out of its existing accumulation phase. And we continue to hold on to the same view. Moving ahead, Nifty Pharma is still on the upper end. It is running up with 0.2% on the weekly returns, and this is holding pretty much well. Same with Nifty Mid Small Health. Though this particular week was not so great, we have seen only 1%, nearly 1% returns over here, but I continue to be bullish on this particular segment. And moving ahead with the Nifty Microcap, there was some kind of profit booking here, especially within the microcap space, and we have seen a negative returns of 0.75%, but this is not something big with respect to the moment what Nifty Microcap can give. So I believe that we have seen the profit booking phase here, and we are waiting the overall broader market to improvise. And moving ahead with Nifty Energy, we have seen a negative returns of minus 2.25. This is the phase we have to be cautious, because in the past week we have not seen any kind of buying in this particular segment. As long as there is no buying involved, this will be a situation where we have to move with caution, because every single support will be broken out at this point. One thing, key observation we have to make here is that it is hovering around the 50 days moving average. From here, I expect the segment to move up again. In case if there is no such movement, we can expect a good amount of correction in this particular space as well. Now moving ahead with Nifty India Defense, this space as well has seen good amount of selling this week, especially around 2%. And if this particular situation continues, we will be a little bit cautious with respect to Nifty Defense. And coming to the final part, or with respect to Nifty Metal, we have booked our profits in this particular sector. Especially we had a very negative week of minus 0.45%, which is not so great. And we have to observe one more point here. In the past week, there was a huge movement up, especially owing to the introduction of IPOs in Nifty Metal segment from Vedanta, and it has proceeded with another leg of selling in this particular week. So at this point, we see this as a caution, and we have exited with our investments, and we don't hold any kind of metal segment in our portfolio anymore. So this is with respect to the leading sectors. And moving into the lagging sectors, Nifty Auto has made a little bit of comeback, but still I would hope that the market takes out the highs of May 2026 so as to confirm that we are in the upward trend. Until then, I'll be a little bit cautious in Nifty Auto, and moving ahead with FMCG, Realty, any other space for that reason, I'm not so bullish at this point. So this is another space with respect to Nifty India Manufacturing. Though this particular segment is trying to break out, we have seen constant selling whenever it reaches the breakout region. So this is a space where we can be bullish, but I would be cautious. In the past, there has not been any kind of moment yet, but I want to see a leg of breakout, which will confirm my conviction saying that Nifty India Manufacturing space has resumed this bull run. Now moving ahead with Nifty Junior, this pattern holds good still. I'm expecting a leg of breakout. The current market is holding good, but as long as it won't break out on the top, I'll not be proceeding with any kind of investment with Nifty Junior. That is Nifty Next 50 here. This is with respect to the Nifty leading sectors and the lagging sectors. And I'll not be touching the Nifty IT segment here, because as long as there is no clear-cut recovery from the sector itself, I will not be interested pretty much in that particular sector. So let me move on to this space. Especially with US-Iran war still hovering around, why should one continue with their SIP and do not risk too much in this particular market? I'm pretty much clear on my stance here. I'm continuing with my sector-based investment, but not with lump sum investments at this point. So let me jump deep dive into this part of why Iran risk is not over yet and what it means for your SIP. See, in the past 75 years, we have seen 5 Arab-Israel wars. Out of that, India has critically been damaged twice, and all the 5 times India has come out unscathed. Basically, we did have kind of a risk hovering around us, but we have come out of that risk pretty much smoothly. Let's deep dive into the situation. Now, moving ahead with the question, should I stop my SIP because of the war? I would say no. In my opinion, this is not a buy sell recommendation, it's not an investment advice. Please do your own due diligence. But let me present my view here. India did go through or face a war with respect to Arab Israel from the year of 1948. Post that, it was in 1956 when the Suez crisis appeared, and again in 1967 when the 6 Days War happened, and again in 1973 where we faced the fourth Arab-Israel War, and in the past the recent one was in 1990, which was called the Gulf War. And on all these 5 instances, India survived pretty much smoothly. Here is how. The first one was in 1948, the first Arab-Israel War. Israel had declared independence in the year of 1948, and the 5 countries, Egypt, Iraq, Jordan, Lebanon, and Syria, announced war on Israel. Let's not get into the specific of why they waged the war, but let's try to understand from the perspective of the Indian economy and how it was impacted. See, this was the first spark which lit the fire, and it has been burning from past 75 years. And India was just a 1 year old as a free nation, and we were agro economy. Basically, the entire economy was dependent on the farming, and we had minimal oil imports. As a result, we did not have much impact. Though this part of situation became very critical because not India was not impacted directly, but it started creating an unstable neighborhood, especially with Pakistan and China, and that led to the first initiation of how countries will be building the geopolitical leverage. Moving ahead with the 1956, the Suez crisis, by then India was slowly moving ahead from the agro-based economy into like oil-dependent economy, but still it was not a major or significant situation. Even when this war happened, Egypt took control of the Suez Canal, and the canal was shut down for 5 months. So that was the first time India did face a critical situation. India was not so badly impacted at this point, but it was a critical warning for us. If that particular route was blocked, the trade shipments would be blocked from moving from India to Europe or any other parts of the nation. And over here, the trade became costlier, and as a result, our export and import was severely disrupted. Though we did not have much of challenges, but this was a clear warning shot for us. Now, moving on to the third war, which was in 1967, the 6 Day War. This was the first break, and we did clearly see the impact, not in the terms of numbers, but in terms of our movement. See, in this war, Israel won the war in 6 days, and as a result, Egypt shut down the Suez Canal for clear 8 years. I'm repeating, it was for clear 8 years. As a result of this, our trade shipments was quite badly damaged, and the relationships what India had with the Gulf countries was not so great. Because of that, the shipments had to face a very difficult situation. And again, I'm repeating, the moment the shipments were moving from India to other parts of the world by bypassing the Suez Canal and moving around the African region. So that literally added around like 2 to 2,500 miles of extra travel, and that cost was borne by the investors clearly. Now, moving ahead to the fourth Arab-Israel war, this is the war which changed the shape of the entire geopolitical situation. In the first initiation, oil was used as a weapon because by then India had become a little bit oil dependent, and as a result of that, Arab countries were playing out the game pretty confidently, and even the world was dependent on oil here. When Israel started invading the space, Arab countries started cutting the oil by 5% every month, and especially Saudi Arabia cut the supply by 10% clearly. Now, how did it impact? Now, oil price quadrupled in as many months. Let's say it moved from $3 to $12 per barrel in just few months. Now, the world had never seen such an impact because world was slowly moving from the dependency on the wood to dependency on oil. This was the first big impact altogether. Now, how in terms of India, we did face a nightmarish situation because our oil import bill raised from 3,500 crores to 9,000 crores. It was a huge jump. Nearly the import bill tripled in 1 year. Now that impacted the food price, As a result of the inflation went up to 20%, and the entire government's 5-year plan was completely hampered. Now, what happened from there? Again, moving to 1990 Gulf War, this was the war which totally changed the complete scenario for India. Now, Iraq invades Kuwait, oil prices spike. Again, we are going back to the same cycle. India's import bill doubles overnight, and 1 lakh Indians were airlifted from Kuwait, which was the largest airlift in history. And again, in the next layer, our forex reserves hit rock bottom, and we had only 3 weeks of support or import money which was left, which was nearly $1.2 billion here. Now, as a result of that, India had to export 67 tons of gold quietly from India to England. You can understand the situation, right? Gold is moving out of the country. There is no clear-cut forex reserves with us, and this gave the birth of liberalization, or what we call the 1991 reforms, and that is the kind of economy we are seeing today. So this has been the history so far, and let's see how India has prepared or came out of the situation. Now, today's situation, that is with respect to 2026, we are seeing the US-Iran war, and again, oil has been impacted pretty badly. And in 1973, we had only one single source. There were no clear backups. We were dependent on UAE or any other Arab region where we did not have the friendly policies with them. As a result of that, we were badly damaged. But in today's terms, we have very good relationships with Russia, Iraq, Saudi Arabia, UAE, US, and we do have multiple amount of backups. Now, moving ahead to the forex reserves. So money in the bank was just $1.2 billion, which was barely 3 weeks of import, which was covered. Had the war been pushed for more than 3 weeks, or that situation continued for 3 more weeks, India would have been bankrupt as a country. I repeat, India would have been bankrupt as a country. But in today's situation, we have $600+ billion in forex reserves, which can cover for an entire year, theoretically speaking. Now, who holds the entire stock market here? In 1973 or 91, it was only a handful of investors, let's say UTC or LIC or any other company, and they were the domestic investors, and less amount of retail participation, and literally there were no foreign investors at all in Indian economy. But in today's situation, Indian SIP, basically the Indian domestic investors, they are there. We have FIIs and we have retail segment as well. And retail segment is very much actively participating in this economy, and we can see that we are pumping in 25,000 crores every month, which is holding the floor completely. So in this perspective, I would say continuing SIP is good, and we cannot see a clear-cut fall from the market. But one thing is certain, oil price is going to impact us a lot. And now let's see how important that it is right now for us. I'm highlighting the chart of oil prices, which saw a spike in from February 28, 2026, from $60 odd to $119, and which was the peak in the month of March 2026. And in today's price, it is at $70, and it has reached the bottom as it was in the month of October, November, December in 2025. We have seen a drastic drop of 41% from the war peak to till date, which clearly showcases that we are in the terms of recovery. From here, the oil prices could bounce back, but owing to the ceasefire, but still I would be cautious, continue to do my SIP. I'll not be worried much about this part. Now, what are the other two signs which most of investors are missing over here? In my past videos, I had given clearly the pointer saying that we'll be tracking the bond prices and the FII's money's inflow. Let's concentrate on both. The first one is whether the foreign investors are coming back. Yes, they are back. Now you can see the amount of buying over here, and with respect to the amount of money flowing in, it is purely into the bond, that is government securities. So basically, FIIs are investing their money, handing over the money to governments, and consistently they have been buying from past 2 months, owing to May and June. And what about the other part? The government borrowing is slowly going down. As a result of that, we can see that whenever the government borrowing goes down, that is better for businesses, and that is better for markets. And that borrowing level has reduced from 7.1% to 6.7% at this point of hour, which clearly gives a clarity saying that good days are ahead. But at this point, for us as retail investors, we should be cautious, but again, we should not ignore the market. I'll take up an example from the recent past, that is from 2022 Russia-Ukraine war, where we saw that whenever the markets found their bottom, sectors bounced back very sharply, especially the auto sector, metals, financial sector, and mid cap and small cap. This is the prime reason why we study history with respect to stock markets. Over here, we can clearly see there are three spaces: metals, financial sector, and mid cap and small cap, which has clearly given good amount of run up, and the same pattern is repeating even today. Maybe auto sector is not moving up as we are expecting, but other sectors are leading the markets. So this is a clear-cut signal for us. Whenever wars break out, metals, finance, and mid-cap, small-cap, they tend to perform well, owing to the current market scenarios. This is just a situation which we have to observe over time. As an retail investor, I'll always keep in mind saying that the crude oil price fell from $119 to $70. My SIP was quietly going in. As a result of that, I was able to purchase more amount of units, and that is going to give me the edge altogether when the market starts bouncing back. And as I mentioned in the past, Indian retailers are pumping in 25,000 crore per month, and they are steady on it. Is market is currently resilient because of this. Now, in the end, I'll come to the clear-cut point. There has been 5 wars with respect to Arab and Israel from past 75 years. I'm not worried about who won the war, who started first, who is going to end it, but I'm going to look at it from the Indian perspective. India has survived all these 5 wars, and in the initial 2 wars, we did not have much of impact. But 1956 and 67 taught us region with respect to the trade route should not be impacted, and 1973 gave the clear-cut warning in terms of economic impact, and 1991 gave us a rise for liberalization. So I would see every single war as an opportunity. Whenever it happens, my SIPs will not stop, my investments will not stop, but I'll definitely make a strategic move with respect to the segments which are going to be impacted and which are going to move first. If you are liking my content, please do like, share, and subscribe. Thank you.